Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help POA students like you ace your exams. Today we have got a practice question which requires you to prepare an expense ledger account and an income ledger account. We will use these ledger accounts to find out the relevant amounts for expenses and income which we will report in the statement of financial performance or the income statement. We will also close these expense and income accounts. And lastly, we will understand two accounting theories which justify the transactions that we are processing for expenses and income, and also why source documents are important. You can see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll explain and go through step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Tom runs a gym. His business financial year ends on 31 July. The following information has been provided. So as you can see, we are given the account balances at 1 August 2023, which are referring to the opening balances for utilities payable and rent income receivable. Now, utilities payable is a current liability. This refers to an expense which we have incurred in the previous financial year ending 31 July 2023, but we have not paid this expense using our cash or our funds available in the bank account. Therefore, this is a present obligation on 1 August 2023 and fits the definition of a current liability. Next, we have got the rent income receivable on 1 August 2023. Rent income receivable refers to funds that you expect to receive from your tenants. You have already given the space which your tenants utilized in the previous financial year ending 31 July 2023, but they have not made that payment using funds from the bank account or any cash. Therefore, you expect some kind of payment in this new financial year starting 1 August 2023, which means you expect some kind of economic benefits, and therefore this falls within the definition of a current asset. Now, let's look into the other information we have got in the question. So during the year ended 31 July 2024, payments made for utilities by check $4,500 and rent received by check $8,700. Now, how can we journalize these two transactions for payments for utilities and rent that we have received? Now, if I want to journalize at 31 July 2024 for the payment that we have made for utilities, when we are making a payment using check, it means that we have made our payment using our funds available in the cash at bank account. Now, cash at bank account in itself is a current asset account. Assets by default are always debited, which means when they increase, they're debited. Now that we have made this payment for utilities, our funds available in the bank account are going down. Therefore, assets are going down. And when assets go down, we credit them. That's why we are crediting the cash at bank account by $4,500, and the corresponding debit entry in this case is the utilities expense account in itself, which is the amount of $4,500. Next, let's look into the rent that we have received in the form of check, which means that we have received this money into our bank account. Now, again, cash at bank account in itself is a current asset, and as we understand, when assets increase, we debit them. Because we are receiving money in our bank account, our assets are increasing in value. Therefore, we are debiting the cash at bank account by $4,500. Simultaneously, the corresponding credit entry is the rent income of $4,500, because this money which we have received in our bank account is basically for rent income, right? All right. So we have also got additional information in this question. First one is utilities of $450 is still outstanding on 31 July 2024. So the key word here is outstanding. This refers to the fact that this utilities is an expense which we have incurred, but we have not paid yet for this amount. Therefore, this is a present obligation at 31 July 2024 and therefore falls within the definition of a current liability. Next, we have got rent income of $3,400 for August and September 2024, which has been received. Now, at 31 July 2024, which is the end of the financial year, we have got 2 months of extra rent, which are the months of August and the months of September 2024. This is therefore rent payment that we have received in advance. And this also refers to the fact that we have got a present obligation at 31 July 2024 because our tenants have not utilized the space which we are renting out at 31 July 2024, and therefore this also falls within the definition of a current liability. Now that we understand the ins and outs of the question, let's look into the requirements. The first requirement is to prepare the utilities ledger account and therefore use this account to find out the amount for utilities expense, and also to prepare the journal entry to show the closing entry at 31 July 2024. Next, we need to prepare the ledger account for rent income and also prepare the relevant journal entry for the closing entry. So let's look into our workings which we have got on the right hand side, starting with the utilities ledger account. Now here you can see we have got the ledger account constructed in the usual 5-column format, with the first column having the dates, the second column having all the relevant cross-reference, which is known as the details column, the third column being the debit entries, the fourth column being the credit entries, and the fifth column being the net balance after we have done our debit and credit entry calculations. All right. So first of all, we understand that at 1 August 2023, we have got utilities payable of $570. And we have clearly identified that this is a current liability because this refers to expense which we have incurred in the previous financial year, but still have not paid using our cash or funds available in the bank account. All liabilities by default should have an opening balance on the credit side, which also means that when liability increases, we always credit them. Therefore, we are starting our utilities expense account on 1 August 2023 with the opening balance, which is also known as the balance brought down, and that amount is $570. And because this is a liability, the balance should by default have a credit balance. So we have 570 credit as the opening balance on 1 August 2023, simply because we have got utilities liabilities. Okay. Next, for the year ended 31 July 2024, we know that we have made some payment for utilities, right? And that amount is $4,500. If you remember the journal entry which we have done earlier, what did we do? We debit the utilities expense account by $4,500 and we credited the cash at bank account by $4,500. And we credited the cash at bank account by $4,500 because our assets are going down in value when we are making the payment for utilities. Okay. Now, note that we are debiting the utilities account by $4,500. This means that in the ledger account for utilities, the amount of $4,500 must be recorded on the debit side based on the journal entry which we have done, with the relevant cross-reference or the narration being the cash at bank account in the details column at 31 July 2024. Okay. Now, 4,500 debits and 570 credits. They're two different things. So what we have to do now, we find the difference between 4,500 and 570, which is 3,930. And obviously we have got more debits than credits, which you can understand based on the substantial amount of 4,500 debit compared to the 570 credit. Okay. All right. Now I need you to focus and see what's going on. Based on the additional information for utilities on 31 July 2024, we have got $450 of outstanding utilities, which as we understand is a current liability at 31 July 2024. This amount of $450 for utilities payable at 31 July 2024 must be carried forward as the opening balance on 1 August 2024, right? So on 1 August 2024, because this is a current liability, the opening balance is definitely going to have $450 credit, okay? Because it's a liability. And the relevant details that we will write is the balance brought down on 1 August 2024 which means that this is the opening balance representing utilities payable from previous year ending 31 July 2024. Now, $450 credit on 1 August 2024 definitely means that at 31 July 2024, we must end with a final balance of $450 credit, right? How do we get $450 credit from $3,930 debit? We need to make sure the entire amount of $3,930 debits is being offset, and then the surplus that remains after the offset is what gives us a final balance of $450 credit. So we can achieve that by simply adding $3,930 with $450, which gives us $4,380 that we must record on the credit side. Again, if you check logically, if we have $4,380 in the credit column, that being offset against $3,930 debit from the previous transaction will eventually lead to a surplus of $450 credit, right? Now, what's this $4,380 credit which we have recorded? This is the amount for utilities expense, which we will transfer to the income summary account as part of our closing entry. So what we write in the details column, we'll write income summary. And just to make things a bit more clear, let's also include the date again, which is at 31 July 2024. We have derived this amount for utilities expense, which is $4,380, and that is the amount which we look forward to transfer to our income summary account as part of our closing entry. All right? Now, having said that, let's look into the closing entry, the journal entry which we have got at 31 July 2024. Utilities expense, the amount which we have calculated is $4,380. So let me just erase that. So we have got $4,380 as the amount for expenses. All right. Now, when we prepare the closing entry for utilities expense, we have to reduce our expenses. If we are reducing our expenses, what do? Expenses by default are debited, which means when they increase are debited. Now that we have to reduce it because we are transferring it to the income summary account as part of our closing entry, we have to credit it, which refers to the fact that we are reducing this utilities expense. So that's why we are crediting utilities expense by $4,380, with the corresponding debit entry being the transfer to the income summary account of $4,380. This entry basically means that all expense accounts are reset to zero in itself, because we want the balance in the next financial year to be zero, just so that we do not double count stuff. So debit income summary 4,380, which means this is the amount which you will report in the statement of financial performance of the income statement as part of your expenses. And then you credit the utilities expense by 4,380 because expense accounts are temporary in nature and we would want to have a net balance of zero in the expense amount itself. All right? Okay. So that takes care of the first part of this question, which is part A. And now let's move to the second part of the question, where we are required to prepare the rent income account. So here you can see the usual 5-column format for the rent income account. And we will start with the opening balance on 1 August 2023, which is rent income receivable of $300. And rent income receivable clearly means that this is a current asset because we expect to receive some money from our tenants in the future, basically within this financial year. And all assets by default must have an opening balance in the debit side. So that is why on 1 August 2023, we have included an opening balance of $300 debit because this is a current asset, okay? Then, during the financial year ending 31 July 2024, we remember that we have received some funds in our bank account for rent. When we receive funds in our bank account, our cash at bank account goes up. Therefore, we will debit the cash at bank account, but at the same time, we will credit the rent income account. Because the rent income account is credited, it means on the credit column, we are recording $8,700, which is the amount which we have received at 31 July 2024 as funds available in our bank account, which takes the relevant cross-reference in the details column, okay? So 8,700 credit is now being offset against 300 debit. Because we have got credits and debits, we subtract 8,700 and 300, and then we get 8,400 with more amounts on the credit side because obviously we have got higher credits than debits so far. Next, based on the additional information for rent income, we know we have received $3,400 as rent payment in advance from our tenants, which refer to the months of August and September 2024, which is the next financial year. So because this is rent income that we have received in advance, this is a current liability because we have an obligation to provide the services to our tenants. Therefore, we understand that at 1 August 2024, the opening balance is obviously a liability and therefore has to have a credit balance. So we are starting 1 August 2024 with an opening balance of 3,400 credit. Now, having said that, we understand that if the opening balance is 3,400 credit on 1 August 2024, this must mean that we are ending 31 July 2024 with 3,400 credit, which is the balance that gets transferred forward in the next financial year. Now, how do we get 3,400 credit from 8,400 credit? So we need to have $5,000 on the debit side, right? So if we have got $5,000 on the debit side, then 8,400 credit being offset with 5,000 debit eventually leaves us with 3,400 credit as the net balance at 31 July 2024. So what is this $5,000? This $5,000 at 31 July 2024 refers to the rent income, the actual rent income which we have earned, the amount that we will report as part of our other income in the income statement or the statement of financial performance. And this amount is what we will transfer to the income summary eventually as part of our closing entry. Therefore, at 31 July 2024, we write income summary as the relevant cross-reference in the details column with $5,000 being recorded on the debit side, which when offset against 8,400 credit from the previous transaction eventually leaves us with $3,400 credit as the final balance at 31 July 2024, and that is the amount which logically gets transferred as the current liability in the next financial year starting 1 August 2024. Okay? Now, how do we prepare the closing entry? Now, always remember, whenever we have got some kind of revenue and income that we have actually earned, it is credit by default. Now that we have to prepare a closing entry where we have to transfer this amount, which means that we have to reduce this amount. So what do? Now that we have to reduce the rent income amount, we have to debit it because it's going down in value by 5,000, and this amount is transferred to the income summary, which is $5,000 credited. This also means when you prepare the statement of financial performance or the income statement, you'll record other income or other revenue of $5,000, okay? And also because of the fact that we want to make sure that this amount of $5,000 for rent income is transferred because we want to start the new period with a zero balance for rent income and utilities expense. Okay? All right. Let's look into the last two questions, which refers to some kind of accounting theories. So state and explain the accounting theory which is applied when calculating amounts for utilities expense and rent income for the year ended 31 July 2024. All right. So basically the question is asking, why are we adjusting for the final amount for expenses and income that we look forward to reporting in the statement of financial performance or the income statement? Because of the accrual theory. Now, the accrual theory states that revenue is recognized when earned, not when cash is received. And expenses are recorded as incurred, not when cash is paid. If we refer this to our question, all right? So, expenses are recorded as incurred, not when cash is paid. For example, you can understand the utilities of $450 at 31 July 2024, which was the current liability. We recorded this as part of our expenses, but we haven't paid for cash yet for this amount, right? And then you've got revenue, which you recognize when you have earned it, not necessarily when cash is received. For example, we started the financial year with a current asset balance for rent income receivable of $300. This refers to revenue that you have earned in the previous financial year ending 31 July 2023, but you have not received the cash, right? But you're still recognizing it as revenue from previous financial year. So these are two examples which you could use to justify this question further. And I believe you can do this easily. Next, we have got explain using a suitable accounting theory why source documents are important, mainly the objectivity accounting theory. The objectivity accounting theory states that accounting information recorded must be supported by reliable and verifiable evidence. So these are the key words here: reliable and verifiable evidence, so that financial statements will be free from opinions and biases. So this is also done to prevent fraud, because you don't want to just include numbers out of nowhere, right? Because you want to make sure every single transaction has actually taken place. And this is also done for the fact that you don't want your expenses to be too high as well, because there is a source document which justifies why some specific amount which you have incurred for expense has actually taken place, right? So therefore, you want to make sure that all your information is supported by reliable and verifiable evidence, so that the financial statements are free from any kind of fraud or opinions and biases of people who may want to manipulate the statements for personal interests, okay? All right, so that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. In the description below, you will find a link to book a free Zoom call with me to discuss your coaching requirements, so that I can prepare you for the exams in October. With that being said, I'll conclude today's lesson, and I'll see you in the next one.